Here as a Chief Executive Officer of Treasury Consulting Pte Limited, which is a Singaporean multinational group. And today we would be covering a very dedicated topic on credit derivatives principal protection notes. Before starting this topic, I would like to take an indemnification from your side. The indemnification is that after 2008, across the globe, there is a perception that the credit derivative is not the right instrument or it is a fake instrument. And with due respect, one of the legendary investors of the globe, which is Mr. Warren Buffett, has clearly said that this is nothing but our weapons of mass destruction. I would like to disregard from both of these facts which are there in the market. It is the credit derivatives that has saved the world in 2008, else maybe without naming the names, a lot of bank and insurance company won't be here today. It is the credit derivative which today is standing approximately 1.17 trillion if I'm not wrong. Credit derivatives are nothing but the backbone of the global financial system. Because we need to appreciate one fact very carefully, that we have a lot of hedging instruments across the globe, which is swaptions, caps, caplets, and so on and so forth, which are able to hedge the cash flow, but they not been able to hedge the credit risk. And for that, we need credit derivatives. In the countries like India, credit derivatives are almost negligible, in fact zero. On the paper, the central bank of the country, Reserve Bank of India, is saying that you have a credit default swap, but if you go in the market, you will definitely not get a buyer of the credit default swap. So theoretically speaking, you have CDS, but you go in the market, you will definitely not have a CDS. Such kind of instruments, which is principal protection notes and all, these is not a reality in India. You will only get these instruments if you are in Singapore, you are in Europe, and to an extent you are in US. But if you're expecting these instruments to get traded in Malaysia, Dubai, Hong Kong, and different parts of the globe, then with due respect, that is quite impossible. Yes, before initiating this video, I would like to say one fact again, that credit derivatives requires in fact, a very good degree of understanding. So if a bank is selling you a credit derivative and you do not have a very good degree of understanding, then boss, you are bound to lose. That is in writing. And especially after 2008, in fact, in the derivative instruments also, we got to know that banks have they did huge amount of mis-selling. So we need to appreciate that mis-selling is something which is quite prevalent in the market. So you have to have a better understanding of the product as far as the mis-selling is concerned. If you do not have a proper understanding of the product and you are expecting a bank to tell you, then this will never happen. And that is what I am saying in every part of our video. Either it's a private placement program, it's a custody business, or maybe a hedging derivatives, and now it's a credit derivative. You should have a very good understanding of the product. Now to start with the topic, we have a topic today which is principal protection notes. To be honest, this is a wonderful topic which we have, because principal protection note is something which is able to help you a lot of ways. Before moving further into principal protection note, let me put again indemnification on this video, which is that in a principal protection note or any other credit derivative, we have pros and cons. Let's take an example. If you are traveling in a flight from India to US or Singapore to US, and you are taking a business class or economy class or first class or any other class based upon your pocket, an economy class person always tend to feel that a business class person is having a better, he's having a better preferences, he'll get a good food. Of course, that is right. But a business class feel that the first class people always get better treatment than a business class. And the first class will think that a cabin people have a better privilege. This is right. Please be note that wherever you are, depends upon your pocket, a person on the other side would always have a better preference. In short, every credit derivative is subject to pros and cons. There is no credit derivative in this world which are not subject to pros and cons. Example, predominantly speaking, credit default swaps are divided into two parts, apparently speaking, which is single name CDS and multi-name CDS. Single name CDS are physically settled, while multi-name CDS are cash settled. So today, if you go to Singapore, US and Europe and you wanted to have a single name CDS and you wanted to have this cash settled, then this job is quite difficult. On the contrary, if you have a multi-name CDS and you wanted to have this physically settled, again this job is quite difficult. So there are few conventions which we have in the market, and that conventions you may name this as a limitation also. I don't mind it, because we have limitations in the credit derivative, but we need to appreciate one fact, that you treat them as a convention or a limitation, we have to live with it. If we do not want to live with it, then we need to spare a good amount of money to remove these conventions or so-called litigations, and that is up to you. Now we are moving there. We are talking about principal protection note, and here we are taking an example. Please note that this is just an example. Treasury Consulting has no, they have no intent just to mention anybody's name. It's just for the sake of example, because it's quite easy that you are able to link with this. So we have a bank which is Royal Bank of Canada, which again needs no introduction. They wanted to issue a principal protection note. Now we need to appreciate one fact, that principal protection note is generally for 10 years period. Sometimes this is more than 10 years period also. There are a lot of people in this world, in a lot of books also, those who refer that principal protection notes are actually zero coupon bonds. But I wanted to tell them that, hello boss, principal protection notes is not, I will now refer this as PPN. PPN is not a zero coupon bond, because in a zero coupon bond is just like you pay 80, you get 100 after a period of time. So 20 is your deemed interest, which could also be referred as imputed interest if I am an economist. On the contrary, in a deep discount bond, you will pay 60 or maybe 70 and you will get 100. So you get a big benefit out of it. So there are a lot of books and there are a lot of media which we have which talks about that PPN, principal protection note, is actually a zero coupon bond. They are practically incorrect. Yes, you should write like that principal protection note is having one feature of zero coupon bond, whereby during the tenure of this so-called tenure, like the issue date and the maturity date, you will not get any interest. Interest will only get at the end of your maturity. That is the right part. But if you do the Google or you refer some books also without quoting the name of the author here, you will get to know they mention that principal protection note is nothing but a zero coupon bond, which is practically incorrect. No, it's not like that. So there are a few things which we have in the principal protection note. The number one is that the amount of the money which you wanted to be raised should not be too much. So example, let's compare with an instrument which is in the news nowadays, which is munis. Munis stands for municipal securities in US. US is the largest munis market which we have across the globe. According to, there are a number of different estimates which we have across the globe which talking about munis, and one instrument is that the muni market is over $100 trillion in US. Now I have not, I never went there. I have never counted one by one investor A to investor Z, so I do not know about it. There are different estimates of the munis market, and if you would have read that nowadays the US bank also wanted to cut down the holding in the munis market, which going to be spark the row, but that we are not discussing here. So similarly in the munis market, what happened, people raise for a very longer tenure. So the municipals of US like Texas Municipal, Philadelphia and different municipals across the US, they take a position for a very longer tenure, sometimes 30-year position also. But we need to appreciate one fact, that the PPN, principal protection note, you cannot take a position more than 10 years, which is the general tendency. So it is just like a MTN, which is medium term notes. So if today somebody come to you and say that what is an exact difference between a medium term note and principal protection note, you will say that the one difference is, which is quite apparent, is that medium term note is a coupon dated instrument, which means that during these 10 years, after every 6 months, which means 20 times, this holder of MTN will get a coupon and the issuer has to pay the coupon. But on the contrary, in the principal protection note, there is no facility of the coupon. This is the hard reality of the life. Another thing is that the amount which you are raising has to be less. It's not like you can rate 100 billion, 200 billion, something like that. We have taken an example of 100 billion here. It's just a hypothetical example. But practically speaking, if you are saying you wanted to hedge more than 100 billion, then there are issues. Till 100 billion, it is okay. In the last several years, we saw several issuances whereby people went and raised 100 billion. That is quite okay. It's fine. Now, what principal protection note will do, in writing, they will give to the people. So, like in a bond, we have a document called indenture. I hope you are aware about that. In indenture, a relevant company will give in writing that where they would invest the money of the bond, and who would be the custodian, who would be basically I would say who would be the trustee, what would be the role of the trustee, what are the contact details of the trustee, and everything they have to mention. This is the law. Similarly, here in the PPN, in the document, you have to the issuance document, you have to mention where you would invest your money. It's not like that a portfolio manager can churn the money on a very frequent basis. Example, a mutual fund. What is the difference between a closed-end and open-end mutual fund? One of the predominant difference between closed-end and the open-end mutual fund is that in a closed-end mutual fund, if you forget the time, in a closed-end mutual fund, basically the asset class or the portfolio which you have shortlisted is more or less fixed. But on the contrary, in a open-end mutual fund, the portfolio manager keeps churning it because he has to make sure that he is with the market. He's at par with the market. He's not out of the market. Now similarly here, you have to first give in writing to the investor, and whenever you change a portfolio, you again have to give in writing to the investor. It is not like that a portfolio manager of the PPN can do anything because he wanted to do it. No. He has certain regulation, like today, which is 13th of June 2018. If Royal Bank of Canada is launching, they need to give in writing that, boss, this is what the portfolio would be and this would be the percentage contribution. And they have to give a tracking error also. Example, tracking error in the sense like plus minus 2%. So if today I am saying 25% would be the contribution, it could go from 20, it could go to 23, it might it might go up till 27 also, plus minus 2%. Here we take an example that Royal Bank of Canada is basically investing in SPDR, iShares, long-term notes, corporate benchmarks, option premiums, and medium-term notes. Now what exactly has happened? Who basically then they would buy these all securities. Once you buy these securities, where you would keep this? This is another practical thing which you will not get in the books. People are saying Royal Bank of Canada will issue PPN, and of course they would issue some security which they sell to investor. Now investor will have that. Now from the money which they get, which is 100 billion, and they are going to buy a few securities which we listed down here, the securities which they would get, they would keep it with the custodians. Now it could be different. It could be State Street, JP Morgan, BNP Paribas. You have endless list, right? So we are not mentioning, we have not specifically mentioned any name. So you refer Mr. C is the custodian. There is a very good thing why they would have with the custodians, because number one is the quantum. 100 billion is a big money. It's not a small money. That we need to appreciate that. And Royal Bank of Canada also practically needs no introduction in this globe. So they would easily have a facility which nobody would have, which is the short-term line of credit. Now what is a short-term line of credit? You can go to our YouTube channel and you can check. There is a video about short-term line of credit, so you can check that. Now who all are the predominant investors? You have qualified institutional investor, you have foreign institutional investors, you have central banks, you have corporate high net worth HNIs, and you have institutions. They are basically the investor. But what is the main important thing? The main important thing is that you have invested in 100 billion. I am just devising, assuming this is 25%, iShares is 10%, LTNs is 10%, say 20%, 35, 45, 65, options premium 5%, 70, and MTNs are 30. Total we have 100%. Let me count again. 35, 45, 50, 70, and 100, right? And you will give a value to the investor which is the beginning value and with the weighted average beginning value both. Assuming the beginning value of the complete is 1000, which is the weighted average. I hope you know how to calculate the weighted average. The beginning value this into the weight, beginning value iShare into the weight, beginning value LTN into the weight, and just like that, assuming the beginning value is 1000. Now at the end of 10 years, since I told you that PPNs have one feature of zero coupon bond, which is that during this you will not get an interest. But boss, this is not a zero coupon bond, that you should know very well. As simple as that. Now at the end of 10 years, assuming we take two options. Market went pretty well and it went down to 1500. It went up to 1500. Predictions turned wrong. Portfolio management was pretty poor. It went down to 900. Now in a PPN, there is they say in a document, in a written form, RBC has to mention that if that is what it is, principal protection notes. If the principal will went down to less than 1000, I repeat, if the principal will went down to less than $1000, which is the money which is you invested, which is the beginning threshold, you will get 0% return. I repeat, your principal will not draw down. Had it been securitization and especially the subprime layer, your principal would have drawn down. Mezzanine, your principal would have drawn down. So there is a wide difference between securitization and this one, and of course the zero coupon bond. So here, even if you started at 100,000, which is the weighted average, and at the end you winded up at 900, which is 10% less, but you will get 0% interest, which means no interest. So you will get your principal back, simple, and job done. However, if it went to 1500, you will declare a 50% return to your investor, which is a substantial return to the investor. But there is a catch in this. You will not get 50%, you will get less than 50%. I will let you know. Now, once you give $100 billion to RBC, RBS will divide this money into RBC will divide this money into two parts. Say 98:2. I'm deliberately going to write here. They are going to divide this into 98:2%. 98%:2%. This 98% would be invested, and rest 2% is they are taking care of the CDS protection, which is credit default swap. Of course, there are various. You have single name CDS, multi name CDS, single trigger CDS, multi trigger CDS. One basket, multi basket, first till default swap, and there are so many things which you have. Now, how exactly it goes? This 50% return, suppose we'll take both the case. Once it turned out to be 1500, you make out 50%, but RBC will not give you 50%. RBC on an annual basis for the 10 years, because RBC has invested your money here. What would if the issuer default? Assuming this is a long-term note. This is long-term note pertaining to any oil company, assuming ExxonMobil or any other company. And what would if they default? Then RBC would lose the entire principal. Now, if you read this document very carefully, they have specifically mentioned. Now, that is an investor's subconscious net, how accurately he is reading the document or the subscription paper, which a subscription booklet, which the bank is giving. It will clearly mention that actually it has two languages. The first is that in case of a default of the underlying security, so assuming you invested in MTN or LTN and suppose it went defaulted, excuse me boss, we are not committed to pay you what you invested. So if they default, they are not committed to pay you what you invested. On the contrary, sometimes the people, the issuer of the PPN, which is RBC and others, they mention that even if in case of default, we will pay you. We'll return you the entire money because we have divided your money into two parts, which is 98%, which is the invested money, and 2% is the CDS cost which we are paying. In the next 10 years, it's just like a protection. RBC will pay 20%, 2% into 10, because the maturity of the PPN is 10 years. So 10 into 2, 20%. 20% to the CDS seller, which is JP Morgan Chase. We are just taking a hypothetical example. JP Morgan Chase, Singapore. Now they are sure that if anything would have happened pertaining to this investment class, JP Morgan Chase Singapore would surely be helping the RBS to return the money. Now that is a different thing, that whether the return in the form of cash or the return in the form of physical settled, that is something reference obligation and notional obligation. It is a technical term we need to see. This is how the PPN will go. And last but not the least, if anything wrong would happen in the market, and there are incidents which are happened in 2008 when not only this investment but also the CDS seller, they both went default, and we saw in 2008, and who knows, we'll see again. There is no guarantee. In that sense, since they have invested in security with a custodian, they have always have an option of the short-term line of credit, which is STLC, which would surely be helping RBC in the bad times. So this is just like a I would say it's just like a very good security which you have, and you are paying almost no cost to that. This is how the PPN work. Nowadays we have different instruments. We have one level higher than PPN. Of course, we would try and cover in the next video, which is known as non-principal protection notes. So NPPN. We have non-principal protection note. This was all about PPN. In case you have any doubts, you are most welcome to contact us at Skype, which is Rahul5327, my Skype ID. My email is rahul.magan@treasuryconsulting.in. My platform is www.fixedincome.global, website www.treasuryconsulting.in, mobile 9899242978. Treasury Consulting is a Singaporean company. We are doing pretty well. We just signed a deal, our consulting deal in Singapore. Our PPP desk is doing wonderful. In case you wanted to have any information, you just need to visit there. You just type it here, and here you will get a detail of our private placement desk, basically www.fixedincome.global. You will get all the details, all the details pertaining to that, like you can see it very well. In case you still have any question, you can come to us. We will surely be helping you out. Have a wonderful time ahead. Thank you.